Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, this is Rahul Shah here, trying to make investing accessible and profitable for the average investor. Now, I did a small study a few weeks back. I analyzed the yearly performance of top 500 companies by market cap going all the way back to the year 2011. I wanted to see what percentage of these companies ended up in the positive in any given year and try and figure out if there's any definite pattern to it. The data is there in the form of a chart on your screens right now. As you can see, 2011, only 9% of the top 500 companies gave a positive return in the year 2011. This means that had you invested rupees 100 in each of the 500 companies, the value of your holding would have fallen to below 100 in a whopping 91% of those companies. That's bad, right? 2012, the situation was reversed. Close to 80% of the companies gave positive returns that year. 2013 again, so only 30% of the top 500 companies give positive returns for the year, and so on. We have that big spikes in the year 2014, 17, 2020B, and 2021. And also we have the big drops in the year 2011, 2013, 2018, and 2020A. And then there are years which are neither here nor there, like 2015, 16, and 2019. Now, I have divided the year 2020 into two halves, 2020A and 2020B. 2020A is the period of coronavirus crash, that is Jan to March 2020, and 2020B is the period of recovery, that is April to December. Now, are these percentages random, or is there some method to this madness? Would it not be great if we come to know whether a large majority of the top 500 stocks are going to end in the positive for the year or negative? Is there any such indicator that tells you in advance about the average performance of these 500 stocks? Let's see at this second chart to find out. This chart is same as the first one, except the numbers you see at the bottom of the screen. This is the Sensex PE at the start of each calendar year. So for 2011, the Sensex PE at the start of the year was 23.6 times. For 2012, it was 16.4 times, and so on. Now let me tell you that the average PE of the Sensex has been in the region of 20 to 22 times. Thus, anything below 20 to 22 times makes the Sensex attractively valued, and anything about 23, 24 makes it overvalued. Now, did you see how those big spikes have occurred whenever the Sensex has traded below its long-term average PE, and how those drops have come whenever the Sensex has traded at expensive valuations? Excuse me. Now, take a look at the year 2012, 2014, 2017, when anywhere between 80 to 90% of the stocks have given positive returns, and where the Sensex was trading at attractive valuations well below 20 to 22 times. Likewise, notice how the performance in 2011, 2018, and 2020A was very poor, and those were also the years when the Sensex was significantly overvalued. The next couple of charts will throw some more light on this analysis. Now, what I have done is I have separated the years where the Sensex was undervalued, that is trading at a price to earnings multiple of less than 22 times at the start of the year, from the years when it was overvalued, that is trading at a price to earnings multiple of more than 22 times at the start of the year. This chart shows the undervalued years. If you would have made your investment based on this indicator and taken a big exposure to stocks, you would have possibly earned good returns in 5 out of the 6 years. Thus, taking maximum exposure to stocks when the Sensex is undervalued and staying this way for the next 12 months would have worked out to be a good strategy. Any decent portfolio of 20 to 25 stocks which were neither junk nor extremely overvalued would have ended up giving good returns over the next 12 months. Let's take a look at the next chart now. This is the chart where the Sensex was overvalued, that is trading above 23 times price to earnings multiple at the start of the year. The percentage of stocks that ended up giving good returns when the Sensex PE was high is indeed on the lower side. Thus, except for 2021, minimizing your exposure to stocks when the Sensex is overvalued works out to be a good strategy. On an average, 70 to 80% of the stocks have lost money in these years, and therefore it was not a good idea to take a large exposure to stocks. I think this has the makings of a good long-term strategy if your goal is to outperform the benchmark index over the long term. You take a large exposure, say 75%, to stocks and keep the remaining in fixed deposits or bonds when the Sensex is below or close to its long-term average, and you do the reverse when the Sensex is overvalued at the start of the year. You reassess again after 12 months and do a fresh allocation based on where the Sensex multiple stands at that time. I know what you're thinking. You're thinking that this is similar to market timing, and timing the market this way has seldom worked. Well, this is not timing but pricing, to be honest, where we are investing more in an undervalued asset and reducing exposure when the asset becomes overvalued. Besides, there is no guarantee that a buy and hold portfolio that believes in buying good quality stocks and staying invested in them for the long term will do better than this approach. I have seen a lot of buy and hold investors get scared out of their stocks at the first sign of volatility. Besides, they often err in assessing the true quality of the stock and are confused what P multiple to pay for it and when exactly to exit. In our approach, though, stock selection plays a secondary role. As long as the underlying stock is not loss making and does not have a balance sheet loaded with debt and is not quoting a P multiple of 50, 60 times, one should be fine in my view. All you need to do is rejig your portfolio at the end of the year, that is, remove the stocks that don't meet your valuation and quality criteria, like a zero debt balance sheet or a certain minimum ROE, and replace them with the ones that do so. Try it out on a small percentage of your corpus for the next 2-3 years and then see whether this works for you. If not, you can go back to your original approach, and if it does, you can maybe allocate more to it. By the way, on the most important question of the day, what should be your strategy for the year 2022? Well, the Sensex is currently well above its long-term average PE multiple, and therefore, there is a good chance that 70 to 80% of your portfolio stocks may go down over the next 12 months. Therefore, if you still have a large exposure to stocks and are sitting on strong gains, it may not be a bad idea to lighten up a bit and get into the safety of a bond or an FD. I know what you're thinking. What if the market does not correct and my portfolio stocks keep going up? Of course, that's always a possibility. But I'm not asking you to get 100% into bonds or FDs. There will still be some allocation to equities which will benefit if the markets go up. But if they correct, you will have a good amount of money at your disposal to get back into stocks at more attractive valuations than today. And as an investor, you need to play these odds if you want to outperform the market over the long term. On that note, I will end my session today. Please share your feedback on this video and please do subscribe to the Equitymaster channel if you haven't already. I'll see you again next time. Take care.